Something big is happening right now in the financial system, and most people are not paying attention. While everyone is watching stock markets, politics, and headlines, gold and silver are quietly sending a very powerful signal. This is not normal price movement. This is not just another rally. This could be the beginning of a major shift in the global financial system. And if you understand what's happening early, it can completely change your financial future. Welcome to Gold Silver Scope, where we break down complex financial events into simple and clear insights so you can stay ahead of the market. Right now, there is one key concept that you need to understand, and that is something called yield curve control. It might sound complicated, but in reality, it's very simple. It is when the central bank steps in and directly controls interest rates, especially long-term interest rates like the 10-year and 30-year bonds. Instead of letting the market decide rates, they set a limit. For example, they might say the 10-year yield will not go above a certain level, and if the market tries to push it higher, the central bank steps in and starts buying bonds aggressively. Now here is where things get serious. In order to buy these bonds, the central bank has to create new money. This is not money coming from savings or taxes. This is money created out of nothing. This is what we call money printing. And even though they may not say it directly, this process is very similar to quantitative easing. In fact, you can think of it as a more controlled and targeted version of money printing. And here's the important part. This process has already started in a small way. The central bank has already been adding liquidity into the system, and the market is beginning to notice it. Gold and silver especially are reacting very strongly. When you see precious metals rising faster than stocks, it usually means something deeper is happening behind the scenes. But why would they even consider doing this? Why would they step in and control interest rates so aggressively? The answer lies in the bond market. The bond market is under pressure, and this is something that not many people are talking about. Governments need to borrow massive amounts of money, and they rely on investors, especially foreign investors, to buy their debt. But what happens if those buyers start disappearing? We are now seeing signs that foreign central banks are reducing their holdings of government bonds. This is a very serious development. For years, global demand for these bonds helped keep interest rates stable. But now, that demand is weakening. And when demand falls, yields rise. Rising yields mean higher borrowing costs, and that creates stress across the entire financial system. This is where the central bank faces a difficult choice. Either they let yields rise and risk breaking the system, or they step in and control those yields by printing more money. And based on what we are seeing, it looks like they are preparing to step in. At the same time, global tensions and economic uncertainty are making the situation even more complicated. Energy prices are rising, trade routes are under pressure, and countries are starting to act in their own interest. This is creating instability in global markets. And in times of uncertainty, investors look for safety. Traditionally, that safety was found in government bonds. But now, that trust is slowly shifting. Instead of bonds, we are starting to see a move toward real assets. Assets that cannot be printed. Assets that hold value regardless of what central banks do. And that's exactly where gold and silver come in. The recent price action in gold and silver is not random. It is a reaction to these deeper structural changes. It is the market quietly adjusting to a new reality. A reality where money printing becomes necessary again. Where trust in traditional systems starts to weaken. And where hard assets become more important than ever. And this is just the beginning. Now let's go deeper into what is really happening behind the scenes, because this is where things start to connect in a very powerful way. The pressure we are seeing in the system is not just random. It is coming from multiple directions at the same time, and one of the biggest signals is coming from foreign central banks. For many years, foreign countries have been major buyers of U.S. government bonds. This helped keep the system stable. It allowed the government to borrow huge amounts of money without causing interest rates to rise too quickly. But now, that trend is starting to reverse. Foreign central banks are no longer buying as aggressively as before. In fact, in many cases, they are actually selling. This is a very important shift. When large buyers start selling, it puts pressure on bond prices. And when bond prices fall, yields go higher. Higher yields might sound good at first, but in reality, they create serious problems. They increase borrowing costs for governments, businesses, and even individuals. This slows down the economy and creates financial stress. But here's the key question. Why are foreign central banks selling? There are a few reasons, and each one is important. First, many countries are dealing with their own economic problems. They need liquidity. They need cash to support their own currencies and economies. So instead of holding bonds, they are selling them to raise money. Second, there is a growing shift in global trust. Some countries are starting to question the stability and reliability of the current financial system. Political tensions, global conflicts, and changing alliances are all playing a role. When trust starts to weaken, countries begin to diversify away from traditional assets. And this brings us to another very interesting development. While U.S. bond yields have been rising, some other countries are seeing the opposite. Their bond yields are staying stable or even going lower. This suggests that investors are starting to look elsewhere for safety. The idea that there is only one safe haven in the world is slowly changing. At the same time, global events are adding more pressure to the system. Rising energy prices, disrupted trade routes, and geopolitical tensions are creating uncertainty. When uncertainty increases, markets become unstable. And when markets become unstable, central banks feel the need to step in. Now think about the situation from the central bank's perspective. On one side, you have rising yields and weakening demand for bonds. On the other side, you have a fragile financial system that cannot handle high interest rates for too long. If rates go too high, it could trigger a chain reaction of problems, from government debt issues to stock market declines. So, what is the solution? The easiest and fastest solution is to step in and control the situation. This is where yield curve control becomes very important. By setting a limit on how high yields can go, the central bank can stabilize the system, at least in the short term. But there is a cost to this strategy. The cost is more money printing. Every time the central bank buys bonds to control yields, it adds more liquidity into the system. This increases the money supply. And over time, this leads to inflation. Prices of goods, services, and assets start to rise. And while this may support the system in the short term, it creates bigger problems in the long term. This is exactly why gold and silver are starting to move. These metals are very sensitive to changes in monetary policy. They react not just to what is happening today, but to what is expected in the future. And right now, the expectation is clear. More intervention, more liquidity, more money printing. And here's something very important to understand. Markets often move before the news becomes obvious. By the time everyone starts talking about these issues, the prices have already moved. That's why early signals are so valuable. Right now, gold and silver are acting as those early signals. They are telling us that something is changing in the system. They are telling us that the current financial structure is under stress. And most importantly, they are telling us that the response from central banks will likely involve more money creation. As this situation continues to develop, the gap between traditional assets and hard assets may become even more noticeable. And this is where smart investors start paying attention. Because when the system starts to shift, opportunities begin to appear. Now let's connect this situation to something even bigger, something that has been shaping the global financial system for decades, and that is the role of the dollar in the world economy. To understand where gold and silver are going, you need to understand what is happening to the dollar system itself. For a very long time, the global economy has been built around the dollar. Most international trade, especially energy trade, has been done in dollars. This created constant demand for the dollar because every country needed it to buy oil and other important resources. This system gave the dollar a very strong position in the world. But now, that system is slowly starting to change. We are beginning to see signs that some countries are moving away from using the dollar for trade. Instead of relying on one currency, they are exploring alternatives. This shift is not happening overnight, but it is happening gradually. And even a small change in this system can have a very big impact. Think about it like this. If global demand for the dollar starts to decrease, then the natural support for the dollar also becomes weaker. And if demand becomes weaker while more money is being created at the same time, it creates pressure on the value of that currency. This is where things start to get very interesting for gold and silver. Gold and silver are not tied to any one country. They are not controlled by any central bank. They have been used as money for thousands of years. And when confidence in paper currencies starts to decline, investors naturally move toward these hard assets. At the same time, we are seeing changes in global alliances and economic relationships. Countries are becoming more independent in their financial decisions. They are looking for ways to protect themselves from external risks. And part of that strategy includes reducing reliance on systems they do not fully control. This shift may seem slow on the surface, but underneath it is very powerful. Now combine this with what we discussed earlier. On one side, central banks may need to print more money to control bond yields. On the other side, global demand for the dollar may not be as strong as it used to be. This creates a situation where the value of money itself becomes uncertain. And when money becomes uncertain, people look for stability. This is why gold and silver start to shine in these environments. But there is another layer to this story. When large systems begin to change, markets do not move in a straight line. There will be volatility, there will be confusion, there will be moments where it looks like everything is normal again. But beneath the surface, the structure is shifting. And this is exactly what we are starting to see right now. Gold and silver are not just moving because of short-term news. They are responding to long-term structural changes. These changes include shifts in global trade, changes in currency dynamics, and increasing pressure on the financial system. At the same time, many people in the mainstream are still focused on the old narrative. They are waiting for inflation to disappear, for interest rates to stabilize, and for traditional markets to return to normal. But what if this time is different? What if the system itself is changing? Because if that is the case, then the way we think about money, investing, and wealth also needs to change. This is where hard assets become very important, not just as an investment, but as a form of protection, a way to preserve value in a system that is becoming more unpredictable. And this is exactly why gold and silver are getting attention again, even if most people have not realized it yet. The early signals are already here. The question is, who is paying attention? Now let's look at what the market is actually telling us through real numbers and performance, because this is where the story becomes even clearer. When you step back and compare different assets, you start to see a pattern forming, and that pattern is very important. Recently, we saw a strong move in gold and an even stronger move in silver. In just one day, gold moved up significantly, but silver moved even faster. This is something you need to pay attention to, because when silver starts outperforming gold, it usually signals growing momentum in the precious metals sector. Silver is more volatile, so it tends to move later, but when it moves aggressively. At the same time, stock markets also moved higher, but not with the same strength. Yes, there was a rally, but when you compare the percentage gains, gold and especially silver showed more power. This tells us that money is starting to flow differently. It's not just chasing stocks anymore. It's also moving into hard assets, and this is not just about one day. When you look at the bigger picture, the difference becomes even more interesting. Over the year so far, gold has been performing steadily. It has delivered solid gains, showing strength even during periods when many people expected it to fall. Silver has also been moving higher, although with more volatility, which is normal for silver. Now compare that to the stock market. Major indexes have not performed as strongly. Some of them are flat, and some are even down for the year. This creates a clear contrast. While traditional markets are struggling to find direction, gold and silver are quietly building strength. Another important signal comes from commodities as a whole. The broader commodity space has been doing very well. This suggests that inflation pressures are still present in the system. Even if the headlines say inflation is under control, the market is telling a different story. Rising commodity prices usually mean that the cost of real goods is increasing, and when real goods become more expensive, it affects everything in the economy. Now let's talk about a very important ratio that many experienced investors watch closely. That is the relationship between stocks and gold. This ratio helps us understand where value is shifting. When the ratio is high, it means stocks are expensive compared to gold. When it falls, it means gold is gaining strength relative to stocks. Recently, this ratio has been moving lower again after a temporary pause. This is a very strong signal. It suggests that gold is starting to outperform stocks in a meaningful way. And if this trend continues, it could point to a larger shift where hard assets take the lead over financial assets. Historically, during times of financial stress or major economic changes, this is exactly what happens. Money moves away from paper assets and into real, tangible assets. And gold has always been at the center of that shift. But here's something even more interesting. Despite this strong performance, most people are still not paying attention. The mainstream focus is still on stocks, technology, and short-term market moves. Very few are talking about the steady rise in gold and silver, and even fewer understand what it actually means. This creates a unique situation, because when an asset class starts performing well but remains ignored, it often means that the move is still in its early stages. The big wave usually comes later, when more people start to notice and enter the market. Right now, gold and silver are quietly gaining strength without much attention. That is usually how major trends begin. At the same time, the underlying reasons for this move are still in place. The pressure on the bond market, the possibility of more money printing, the shift in global financial dynamics, and the uncertainty in the system, all of these factors are supporting precious metals. So when you combine strong performance with strong fundamentals, it creates a very powerful setup. And this is exactly what we are seeing right now. The market is sending signals. The data is confirming those signals. And the only question left is how long it will take for the rest of the world to realize what is happening. Now, when you put everything together, the picture becomes very clear. We are looking at a system that is under pressure from multiple sides. The bond market is struggling, foreign demand is weakening, global dynamics are shifting, and central banks are being pushed toward more intervention. And when central banks step in, it almost always leads to one thing: more money being created. This is not something new, but the scale of what could happen next is what makes this situation different. If yield curve control becomes a reality, it means interest rates will no longer be fully controlled by the market. It means artificial support will be added to keep the system stable. But that stability comes at a cost, and that cost is the long-term value of money. At the same time, we are seeing early signs that confidence in traditional systems is starting to weaken. Countries are making independent moves. Markets are reacting differently. And safe haven flows are no longer going in just one direction. All of this points toward a slow but powerful shift in the global financial structure. And in the middle of all this, gold and silver are quietly positioning themselves. They are not reacting to headlines. They are reacting to the bigger picture. They are responding to the possibility of more liquidity, more inflation, and more uncertainty. And history has shown us that in times like these, hard assets tend to perform very well. But here is the key thing you need to understand. These moves do not happen overnight. They build over time. There will be ups and downs. There will be moments of doubt. But the direction is what matters. And right now, the direction is becoming clearer with each passing day. The biggest mistake most people make is waiting until everything becomes obvious. By the time the majority understands what is happening, the biggest opportunities are already gone. That is why paying attention to early signals is so important. Right now, those signals are coming from gold and silver. This could be one of those moments where the market is quietly preparing for a much bigger move, and those who understand it early have the advantage. If you want to stay ahead of these trends and understand what's really happening in gold and silver markets, make sure you follow Gold Silver Scope, where we break down complex financial shifts into simple insights so you can make smarter decisions.